Hey there, Brad Castro from GreatOptionTradingStrategies.com. I watch and rewatch a lot of violent and psychologically gritty shows like Peaky Blinders, Deadwood, The Last Kingdom, Justified, Yellowstone, etc., which I feel is good preparation for my daily interactions with Mr. Market. One such show, which I don't feel has gotten a lot of attention, is from the extremely prolific Taylor Sheridan, Tulsa King. The show stars Sylvester Stallone as a lieutenant to a New York mafia family who, after a lengthy prison sentence, is exiled to Oklahoma of all places, with instructions to set up a brand new criminal enterprise from scratch, and basically with no resources or help from New York. I love the concept and the challenge. How do you create something of value out of thin air? Or rather, how do you leverage opportunities others don't see and combine it with your own resourcefulness and insights? If only we could do something like that in the stock market. Well, of course we can, and that's what this video today is about. I'm going to share with you an approach I call the Option Trading Kingpin Strategy. It's a creative and savvy way to build out a full investment position in a specific stock and to basically have Mr. Market pay for most, if not all of it. Seriously. And then, once fully established, have that position continue generating high amounts of cash flow and income for you on an ongoing basis. But before we dive into all that, let me give you some real quick background and context. I've been trading options, mostly selling them since 2002. I launched the Great Option Trading Strategies website way back in 2008, where over the last 17 years, I put together a ton of resources, free downloadable guides, ebooks, special reports, case studies, etc., and nearly 300 articles on all aspects of selling options for income, as well as incorporating options into value investing and/or dividend growth portfolios to further stack the deck in your favor. And that, incidentally, is kind of what we're going to be looking at today with the Kingpin Strategy. And 13 years ago, I started my private option trading membership site, the Leveraged Investing Club. Not currently accepting new members, so no worries about a sales pitch here. But if anything we covered today resonates with you, you might want to check out the Great Option Trading Strategies website and all the resources available to you. I've added links to the site and the free downloadable library page in the description section below. And I've also pinned a direct link to my daily option tips and insights newsletter sign-up page in the comments section. Okay, let's get back to becoming kingpins. Now, I'm going to break this video up into 3 parts. In part 1, I'll lay out the key steps to the strategy. In part 2, we'll look at a real-world example where I'm currently building out such a stock position. At this point, I have 20% of the total number of shares I ultimately want, and these have an adjusted cost basis of roughly 50% of what I paid for them on the open market. In other words, Mr. Market has so far refunded me about half of my open market purchase price. And I'm just getting started. Finally, in part 3, we'll look at the strategy more critically and consider the trade-offs, drawbacks, and potential limitations of the strategy. Okay, part 1, the 6 key steps to the Option Trading Kingpin Strategy. Step number 1, identify the stock you want to own at a heavily discounted price, or even better yet, for free. And in part 3, we'll look at what stocks make good candidates for the strategy and which ones don't. Step number 2, determine the number of shares you ultimately want to own. Step number 3, sell or write a corresponding number of put contracts to how many shares you ultimately want to own, i.e. 1 contract per 100 shares you're targeting as a full position. Now, so far this is similar to what I call generic or beginning put selling to acquire stock at a small one-time discount, which is the tired advice you always hear to sell puts at a strike you wouldn't mind owning the stock at, and then either pocket the premium as gains or allow assignment and buy the shares at the strike price agreed upon and then deduct the initial premium received to determine your adjusted cost basis. But that's not what we're doing, because we're kingpins, and kingpins aren't interested in small one-time discounts. At the end of the day, we want to acquire our assets for very little, preferably nothing at all, and then have them pumping out lots of income for us, ideally forever. Step number 4. So here's what we're going to do. We're going to take the premium we collected from selling our initial round of puts and buy shares on the open market. Now, it's up to you how many shares. Personally, I like to keep the numbers clean and round, like 100 shares or even 50, or at the very least 25. A lot is going to depend on how much premium you bring in, what the underlying share price is, and how many short puts you're working with. But some basic math here. The more shares you purchase, the less your initial discount will be, and vice versa in the other direction. In fact, if you wanted to, you could run a zero cost basis position from the very beginning and only buy shares on the open market that were fully covered by the initial premium received. In my personal position where I'm running the strategy myself, as we'll see in part 2, I have a roughly 50% discount because I'm buying 100 shares at a time. If I wanted to maintain a 100% discount structure to the position, I would be buying closer to 50 shares at a time. Okay, step 5. Step 5 is optional, but if you do initially acquire 100 shares or more, you might also consider selling an out-of-the-money covered call to bring in even more premium. And that's especially true as you build your stock position up over time because covered calls will help accelerate the process. And once your position is fully built, they're going to be a great source of ongoing cash flow and income. Step number 6, rinse and repeat. You can continue selling or rolling the same number of puts as your stock position gets built out, or you can choose to gradually reduce those over time. For example, if your target is a 1,000 share position of a stock and you've built the position up to 900 shares, you might not want to continue selling or rolling 10 puts per round. At this point, you're going to have opportunities to sell an increasing number of covered calls against your larger stock position anyway. Incidentally, owning shares of stock and simultaneously selling out-of-the-money puts and covered calls is a strategy that used to be called a covered combo. So I suppose this is a variation of that, but it's a variation that's on steroids. And I think a better way of viewing the strategy is that you're selling options on and around a specific stock, but instead of getting paid in cash, you're essentially getting paid in stock, or at the very least, heavily discounted stock. Okay, that is the very general, very broad overview of the strategy. That's the theory part. And anyone who's had any experience selling options knows that nothing works out this simply and cleanly. It would be naive to think so, and it would be extremely dishonest of me if I tried to persuade you that there's a simple and mechanical approach to deliver these results with no complications. The devil is definitely in the details, as they say. And that brings us to part 2, where theory meets real-world application. And also in part 3, we'll look at the strategy more critically and consider its trade-offs and potential drawbacks and what can go wrong. Part 2, a real-world example of the Kingpin strategy. All right, now for the fun part, seeing this strategy at work in the real world. As I mentioned earlier, I personally have a Kingpin strategy campaign going where to date I've acquired 200 shares towards an ultimate goal of 1,000 shares. The stock ticker is OSCR, or Oscar Health Incorporated, a mid-cap health insurer with a $5 billion market cap. Now, the purpose of this video isn't to make an in-depth bull case for Oscar. I will say that it seems to be a well-run, founder-led health insurance company with plans to expand into new markets, but it also has a significant exposure to the health insurance marketplace, aka Obamacare. And if that gets gutted, then there are definitely risks to the downside. So there are risks involved here. The takeaway then is that for me personally, I like the long-term prospects of the company. I'm willing to tolerate volatility, and I'm taking advantage of that volatility and the creative flexibility of option selling in the attempt to acquire a 1,000 share position for as little as possible, and then, ideally, benefit from capital appreciation over time as well as generating lucrative amounts of income on an ongoing basis. That's not so much to ask, is it? Now, whether or not I have an actual zero adjusted cost basis at the precise moment I've acquired my last share isn't that important. I expect my adjusted cost basis will be plenty low at that point, and that over time, and by incorporating future accumulated premium income, the position will be fully paid for many, many times over. Okay, so let's look at the 2 rounds I've so far played in this game with Mr. Market. There are a couple of spreadsheets/tables here which I hope are large enough for you to make out on the video, but if not, or if you'd like to check them out more closely, I've included screenshot links in the description section below. But it's pretty straightforward. On August 18th, 2025, I bought 100 shares of Oscar on the open market for about $15.96 a share. I also sold 10 September 19th, 2025 $15 puts for 94 cents a contract. At this point, Oscar was trading at $16.03 a share. Finally, a little later in the session, with Oscar now trading at $16.46 a share, I sold a single out-of-the-money September 19th cover call for another 95 cents a contract. So at this point, I paid $1,596.83 on the open market for 100 shares of Oscar. But between the 10 out-of-the-money short puts and the single out-of-the-money covered call, I brought in $1,029.90 of premium. Now, this is important. As long as any short option position is still open and active, I don't consider the premium received to be officially booked income. But still, you can see the rationale here. Subtracting the first round of total premium received, $1,029.90, from the open market cost of the first 100 shares purchased, or $1,596.83, adjusts the net purchase cost of those 100 shares to just $566.93, or an adjusted cost basis of $5.67 a share. Not bad for an opening gambit, right? That brings us to round 2. After setting up the campaign in round 1, Oscar began grinding higher so that on September 4th, a little more than 2 weeks before the September monthly expiration, there wasn't a lot of time value remaining on my $15 short puts. So I rolled those out and up to the $16 strike price and the October 17 monthly expiration date for a 65 cents a contract net credit. I bought to close the September $15 puts for 19 cents a contract, and I sold to open the October $16 puts for 84 cents a contract. After commissions and fees, that brought in another $640.75 of new net premium. But at this point, Oscar was trading above $18 a share, which meant my September $18 covered call was now in the money. So on the same day, September 4th, I rolled my September monthly covered call out and up from the $18 strike price to the October 17th monthly $19 strike price for a decent 35 cents a contract net credit. Bought to close the September 18 covered call for $1.35 and sold to open the October 19 covered call for $1.69. This is also when I purchased my second round of 100 shares of the stock. This time I paid $18.37 a share on the open market, or $1,837.82 after commissions and fees. And while I collected more net premium from rolling both the short puts and the single covered call, I obviously didn't collect as much in round 2 as I did in round 1. In round 2, I only brought in $674.83 of new net premium, meaning after adjustments and such, my net purchase cost of the second 100 shares was $1,162.99, or basically $11.63 a share. Now, as I mentioned earlier, there was no rule that said I had to buy 100 shares in round 2. If I'd wanted to maintain a lower adjusted cost basis at this point, I could have simply bought fewer shares, like 50 shares, for example. 50 shares would have cost $918.91, which would have been covered a lot more by the $674.83 of net premium generated in round 2. But I like the flexibility of having 200 shares to work with and the ability to add a second covered call if necessary to help work the strike price higher on my first covered call, if the stock continued trading higher and it became necessary to do so. And even with the higher adjusted cost basis of round 2, on an overall basis, things are still looking very good in my opinion. I have 200 shares of Oscar that I paid in total $3,434.65 a share for on the open market for a non-adjusted cost basis of $17.17 a share. But after 2 rounds of short puts and covered calls, I brought in $1,704.73 of accumulated net premium, which means that my overall net purchase price of those 200 shares is currently $1,729.92, or $8.65 on an adjusted cost basis. That works out to be a 49.63% discount to the open market purchase price. At the time I'm putting this video together, there's still a week to go until the September monthly expiration and 5 weeks until the October monthly expiration. So for now, I just wait and let the campaign and the stock do their thing. I'm basically monitoring remaining time value on my short puts and covered call, and once those get sufficiently low, I'll look to my next roll or adjustment. I'll make an update video when that happens, so be sure you're subscribed if you're not already. Now, for round 3, I may scale back my open market stock purchases. Maybe buy fewer shares, or maybe not even buy any during round 3 and simply allow the adjusted cost basis to take a big step down. But a lot may also depend on the technicals at the time, because I don't envision this strategy as highly mechanical or heavily rules-based. I see it as making informed choices based on whatever the current conditions on the ground are. For example, if the stock becomes technically overbought at some point, or if it looks like it's running into resistance and is vulnerable to a pullback, I wouldn't want to buy any new shares at that point, regardless of how much accumulated net premium I brought in. And vice versa if the stock sells off at some point, or is technically oversold, or appears to be bottoming and finding support somewhere. In that kind of situation, I'd prefer to be more aggressive acquiring new shares and worry about the adjusted cost basis later. Bottom line, the strategy as I envision and strive to trade it involves exploiting the mathematical structural advantages of selling options in a creative way to acquire shares of a stock on the cheap, but also incorporating technicals to help with the timing and make the whole process even more efficient and effective. Let me know in the comments if that makes sense or not. Part 3, Trade-offs, Drawbacks, Limitations, and Challenges. All right, let's take a more critical look at the Option Trading Kingpin Strategy. Now, one thing I've always said is that options are always about trade-offs. So what are the trade-offs here? The biggest trade-off in my view is that while the Kingpin strategy can result in ownership of a full stock position with a very low adjusted cost basis, or even better, no cost basis, it's not going to happen overnight. Now, it's true that I've gotten up to a great start with my OSCR campaign, but I anticipate that the whole acquisition process will likely take between 1 and 2 years to complete. So it does require patience. But I think that the end result, if I can pull it off, will be more than worth it. And that's having 1,000 shares of a stock that I've largely gotten for free and which can then be used to generate lucrative amounts of income and cash flow for me on an ongoing basis. But that brings up a second point. To suggest that my shares of the underlying stock are free or that I'm creating them out of thin air or any of that, isn't that kind of dishonest or a form of cheating? Surely there is an actual cost that I'm glossing over. Not only does the process require time, it also requires capital. If, as in my OSCR example, I'm selling or writing 10 times the number of contracts to the number of shares I'm buying on the open market at any given time, surely I'm having to tie up a lot of capital to get all this done. Well, yes and no. If you're doing this in a retirement account or completely on a cash secured basis, then yes, the capital required for selling your puts would be the number of contracts times the strike price at which you've written those puts times 100, since each contract represents 100 shares. So in my current OSCR setup where I have 10 short puts at the $16 strike price, I'd be looking at a $16,000 cash secured requirement for this leg of the campaign. Now, you obviously want to be very responsible with leverage and margin, but one of the great things about selling puts on margin is that there's no actual interest expense involved. But check this out. On a margin basis, my current position, 200 shares of the underlying stock, 10 short puts, and 1 covered call, actually requires very little to maintain. Based on the current share price here, the value of my 200 shares of OSCR is about $3,860. And you can see in the far right column that the buying power effect is a positive $1,663.92, meaning that the overall position is adding $1,663.92 to my margin power. In other words, the position is negatively impacting the amount of my margin available on my entire portfolio by only around $2,200. Now, of course, at this point, my 10 short puts are all nice and well behaved and comfortably out of the money. If the stock were to sell off, however, and those short puts started trading in the money, the hit to my margin/buying power would definitely increase. But it also works the other way. As my share count increases, more and more of the trade is collateralized by the stock position itself. Again, you should always use margin conservatively, but bottom line, on a margin basis, the Kingpin strategy doesn't really require all that much capital. Okay, here's another potential criticism. Am I cherry picking an example here with OSCR as it's both a lower price stock and its options have high implied volatility levels? Well, as far as the share price goes, I don't see how that necessarily matters all that much. I basically view OSCR as a $20 stock that I believe will one day trade at $40. And if I'm totally wrong, it could become a $5 stock. So 1,000 shares of a $20 stock is a $20,000 position. If I were targeting a $200 stock instead and wanted the same position size, I would only be looking to acquire 100 shares, not 1,000. And I'd likely only be selling 1 put at a time and picking up just maybe 10 shares at a time. Now, the implied volatility issue is a fairer point. OSCR option premium levels are pretty elevated here, but instead of that being a criticism, I think we should take it as more of an insight into what stocks make good candidates for the Kingpin strategy and which ones don't make good candidates. A nice, boring blue chip stock with lower option premium levels would not be a good choice. It would take much longer to build out a position because the stock position is being subsidized entirely by all the premium you're able to sell over time. So the Kingpin strategy is much better suited for more growth-oriented type stocks with higher premium levels. Of course, you shouldn't just blindly chase premium. Whatever stock you're working with should be one you truly believe in and want to own. Finally, and this is a challenge that I foresee, even if it's not something everyone would anticipate, but it's something I don't want to ignore or gloss over. And that's that long-term campaigns almost certainly involve complications at some point. Volatility in itself is not the same as risk, but at some point, some part of the trade will end up in the weeds and need to be dealt with. Now, the beautiful thing about selling options is that, unless some form of self-sabotage is involved, just about any trade can be repaired. Check out my Put Selling Trade Repair playlist if you don't believe me. Except on rare occasions, you should never lose money selling options. So I'm not really worried about the ability to fix anything that needs to be fixed, but at some point, something likely will need to be fixed, and that's going to slow down the campaign. Okay, there you go. That's both the broad overview of what I'm calling the Option Trading Kingpin Strategy, as well as the specifics of how I'm implementing the strategy in the real world. I also plan to post new videos to provide updates on my OSCR campaign as I continue to build out the full position over the next year or two, so be sure you're subscribed to the channel to stay in the loop. Theory is great, of course, but you learn so much more by actually doing, or watching someone doing in this case, so stay tuned. Okay, I would love to hear your feedback, questions, etc. If you want me to clarify anything, or if there's some other aspect of the strategy you'd like me to address, let me know in the comments below. And if you enjoyed this and want more, be sure to check out the channel's other videos. I'm actively adding new content again and have a backlog of video ideas I want to share with you. I'm also organizing these videos in various playlist categories, so that should make it easier for you to find the resources that are the most valuable to you. Also, sign up for the Daily Tips newsletter via the pinned comment below. Options are the ultimate high-yield income vehicle and wealth-building vehicle, and they can be structured in so many different ways to generate sustainable and safe high-yield income. The Daily Tips newsletter is a perfect complement to this channel because I can cover more topics, and sometimes deeper, in written form versus video form. Again, you can sign up directly, or there's also a link in the description section below to the Great Option Trading Strategies downloadable library page. Download anything from there, and you'll also begin receiving the Daily Tips newsletter automatically. Heads we win, tails Mr. Market loses. That means you should be coming out ahead on virtually all of your trades. And all of your campaigns too, for that matter. Okay, until next time.